Right now, as you're sitting there watching this, there is a computer system inside HMRC that already knows more about your money than your own accountant does. It knows what lands in your bank account. It knows what you sold on eBay last month. It knows the value of your car, the value of your house, and yes, it has probably seen those holiday photos you posted last summer too. And here's the part that should make you sit up. In the last financial year alone, this one system quietly clawed back £4.6 billion. Not through raids, not through tip-offs from angry ex-partners, just through data, cold, patient, relentless data. So in the next few minutes, I'm going to walk you through the exact mistakes that light you up like a Christmas tree on HMRC's radar. And more importantly, how ordinary, honest people get dragged into investigations without ever doing anything deliberately wrong. Stick with me right to the end, because the last one is the mistake almost nobody sees coming. And it's the one that turns a 5-minute letter into a 5-year nightmare. Let's get into it. The system I keep mentioning has a name. It's called Connect. HMRC built it back in 2010, but calling the version running today the same tool is like comparing a candle to a floodlight. It now pulls information from over 30 different sources and cross-checks more than 22 billion lines of data. Banks, employers, the land registry, the DVLA, payment platforms like PayPal, Stripe and Etsy, overseas tax authorities in more than 20 countries. And here's a statistic that stops people in their tracks. Roughly 9 out of every 10 HMRC investigations now start with this machine. Not a whistleblower, not luck. An algorithm. So the old comfort blanket, they'll never find out, is gone. It's dead. It's been dead for years. Now, the number one thing Connect looks for is beautifully simple. It's a mismatch. Money going into your accounts that doesn't line up with the money on your tax return. Let me paint you a picture. Say you declare income of £55,000. Nice, respectable number. But across your accounts, your personal bank, your PayPal, maybe a savings pot earning interest, there's £75,000 flowing through. Now, that gap doesn't automatically mean you've done anything wrong. Maybe some of it's a loan from your mum. Maybe you sold an old car. Maybe it's a refund. But to Connect, none of that context exists yet. It just sees a £20,000 hole. And it doesn't shrug and think, probably fine. It thinks, explain this, and this is where I need you to really understand something. From January 2026, HMRC completed its first full cycle of data straight from the selling platforms. eBay, Vinted, Airbnb, Etsy, Just Eat. They are now legally required to report your earnings directly to the taxman. Not if he asks. Automatically. Every year. So that little side hustle you thought was invisible, TikTok Shop can report what they paid you down to the last penny. And if your tax return doesn't match their figure, even if you were just being sloppy, the flag goes up. The lesson here is almost boringly simple, and I'll say it more than once today because it matters. Keep your business money separate. A dedicated business account creates a clean line. Business income goes in one place, and only your drawings or salary touch your personal account. That one clean separation has been used over and over to stop HMRC from rummaging through someone's private spending. Because once they're in your personal account, they see everything. The birthday money, the lottery win, the lot. Right. Red flag number 2. And this is the one people trip over while they're actually trying to be clever. Expenses. Everybody wants to lower their tax bill. That's completely normal and completely legal. But Connect doesn't just look at what you earn. It looks at what you claim against it. And it doesn't judge you in isolation. It compares you to thousands of other businesses just like yours. This is called benchmarking, and it's ruthless. So picture a consultant pulling in $72,000 a year, but claiming $46,000 in expenses. HMRC's first question isn't even angry, it's just practical. How exactly are you living on what's left? And when your costs sit miles above the average for your trade, you become what they call an outlier. And outliers get pulled for review.
Yeah,
Here's something that trips up more people than you'd think. Round numbers. Genuine business expenses are messy. They're £487.63, when HMRC sees 5,000 here, 10,000 there, all suspiciously tidy. It doesn't read as organised. It reads as guessed. And guessed numbers make an inspector lean forward in their chair. So how do you stay safe? Only claim what genuinely belongs to the business. Keep every receipt because the rule is brutally simple. No receipt, no claim. HMRC isn't interested in, it felt business related at the time. They want proof the cost was, in their words, wholly and exclusively for the business. And if a number is large or unusual, let someone sanity check it before it goes anywhere near your return. Now, red flag 3. This is where HMRC gets genuinely forensic, and I want to tell you a story that honestly sounds made up. It isn't. Cash. Let's be crystal clear. Cash is not illegal. Nobody's saying that. But cash is harder to trace, and Connect has one blind spot. It cannot see a cash transaction that never touches a bank or a card machine. So HMRC compensates. For cash-heavy trades, restaurants, takeaways, barbers, taxi drivers, market stalls, mechanics, beauty salons, they pay very, very close attention. And they use benchmarking to sniff out anything that doesn't add up. Here's the story. A business ran a couple of restaurants, fairly close together. They got a letter from HMRC, looked routine, nothing dramatic. But then the inspectors asked for the records of 2 specific days. Not a month, not a week. 2 exact days. And that's strange enough that the accountants requested the full data HMRC were relying on. Which, by the way, is something you're allowed to do. What came back was extraordinary. HMRC had been sending its own staff into those restaurants over those 2 days, in pairs and in threes, different combinations. And every single time, they paid in cash. They used a VAT check as the cover story. And while they ate, each inspector was secretly noting how many staff were working, how many diners they could count, how busy it looked. One of them even sketched a little map of where everyone was sitting. Sounds like something out of a spy film, doesn't it? But it fell apart. Their notes contradicted each other. And crucially, they'd completely ignored the fact that this was effectively a small chain that shared staff between sites during busy periods. It got dismantled, but not before costing the business real time, real money, and a mountain of stress. And the kicker, this wasn't a one-off. HMRC rolled that same exercise out across the country to test cash reporting. So protect yourself the boring way. Record every single cash sale. Reconcile your takings daily. Keep a proper cash book. Make sure your stock and supplier spending actually lines up with your sales. Because cash isn't the problem. Bad records are. If your numbers tell one clear, consistent story, HMRC loses interest fast. If they don't, HMRC writes the missing chapters for you. And trust me, they never give it a happy ending. Now, before I hit red flag 4, I want to give you the number that changes how seriously you take all of this. Because a lot of people think, so what? Worst case, I pay a bit of extra tax. No, here's what's actually on the table. If HMRC decides you've simply been careless, they can reach back 6 years. If they decide it was deliberate, that you knew and hid it, they can go back 20 years. 20. Think about that. Records you threw away a decade ago. Deals done by people you've lost touch with. Memories that have faded. All of it suddenly back on the table. And the penalties stack on top of the tax you owe. For a careless error, up to 30% of the extra tax. For deliberate, up to 70%. And for deliberate and concealed, where you actively hid it, up to 100%. That means you could owe the tax, plus the same amount again as a fine, plus interest running the whole time. As of 2026, that late payment interest sits at 7.75%, ticking away in the background like a meter in a taxi you can't get out of. So this is not a pay a bit extra situation. This is a lose years of your life and a chunk of your net worth situation. That's why the boring paperwork matters. Right. Red flag 4. VAT. VAT is very often where HMRC starts an investigation, but very rarely where it finishes. Because HMRC loves patterns, and VAT returns are where patterns break in the most visible way. And it doesn't take anything dramatic. Small repeated things are usually enough. Late returns are the first one. Even if you owe nothing, even if it's a zero return, filing late again and again tells HMRC one of two things. Either your records are a mess, or you're buying time. Neither looks good. In fact, even 2 late VAT returns can be enough to prompt a compliance check. Then there are constant nil returns, or a suspicious drop in turnover while your card machine and your website traffic say you're actually busy. Connect cross-references, all of that, and the contradiction jumps straight out. But here's the VAT trap that catches people who think they're being smart, running 2 businesses that are really one. Same customers, same suppliers, same branding, sometimes even the same bank account. HMRC can look at that and say, no, this is one business artificially split to stay under the VAT threshold. They combine the turnover, backdate your VAT registration, and hand you a bill for VAT you should have been charging all along. That one hurts. So stay consistent, file on time every time, only reclaim VAT that matches your real sales. And if you genuinely run more than one business, keep them genuinely separate. Not just separate on paper, but separate in reality. And now, red flag 5, the one almost nobody sees coming. Because it isn't clever, it isn't complicated, and that's exactly why it's so dangerous. Deadlines. Missing a deadline feels administrative, trivial, a bit of paperwork you'll get to. But to HMRC, it's a signal, and it's one of the fastest ways onto their radar. Miss a self-assessment deadline and you get an automatic £100 penalty. No discussion, no, but I was busy. It just lands. Leave it longer and interest starts building. Longer still, and more penalties pile on. And here's what people don't realise. Keep ignoring it. And HMRC stops waiting for you altogether. They simply estimate what you owe themselves. It's called a determination. And they always assume the worst case number. Then it becomes your job to prove them wrong. Now here's the big one for 2026. And if you take one practical thing away from this video, make it this. From the 6th of April 2026, making tax digital for income tax became mandatory for sole traders and landlords earning above £50,000. That means digital records, compatible software, and quarterly updates, 4 submissions a year instead of 1, 4 times the deadlines, 4 times the chances to slip up. And HMRC has openly confirmed that simply not signing up for the right software is now, by itself, a high priority risk indicator. Not doing it is a flag. Full stop. So get your systems sorted now, before a deadline is staring you in the face. File on time even when you can't pay. Because filing late and paying late is a far, far worse position than filing on time and asking for a payment plan. HMRC is genuinely more forgiving to people who stay in touch, and far harsher on those who go silent. And that brings us right back around to where we started, because here's the truth almost nobody tells you. Most HMRC investigations don't begin with fraud. They begin with something small. A missed deadline, a mismatched figure, a messy set of records left to fester too long. Around 300,000 investigations open every single year, and the vast majority of them are just untidiness that snowballed. Almost everyone begins the same way, with a letter. And that letter does not mean you're guilty. It means something didn't match. The real danger isn't the letter. It's what people do next. They panic. They ignore it. They guess at answers. They fire off a chaotic pile of documents that raises 10 new questions for every one it answers. A calm, organised, professional response can close an inquiry in weeks. A messy one can turn a simple check into a long, expensive, sleepless headache. So keep your money separate, keep your records boring, file on time, and deal with problems while they're small, because a small problem you face today is a fraction of the size of the same problem in 20 years' time. HMRC is watching. But if your numbers tell a clean, honest, consistent story, there is genuinely nothing there for them to find. And that, more than any clever trick, is what keeps you off their radar for good. I'll see you in the next one.